But the real growth spark for me was when I quit my job, when I quit my law enforcement job. I put in my 2 weeks notice. I told all the guys, I said, hey guys, I just put in my 2 weeks notice. I rented the room down at the community center. I want all you guys to come. I'm going to tell you all the stuff I've been doing in real estate for all these years, so you can hear why I'm quitting. And so they all came, and I gave this whole presentation about real estate and median values and flipping and all this other stuff. And I'm like, if any of you guys want to invest with me, you can give me your money, minimum $5,000, and I will split the profits 50-50 with you. And I literally walked out of that room with $500,000 of investment money from 28 investors, all carrying guns. That was how I got jumped into the fund business.
This is episode number 09 of Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
and Julian Sage,
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, deal makers? Julian Sage, and in this episode, I have the special honor of speaking with Brian Burke. Brian is the founder and CEO of Praxis Capital, a vertically integrated real estate private equity firm that has over $200 million of assets under management and over 3,000 doors. Brian shares his story of how he fell into real estate and built a successful business, flipping homes and acquiring them at auction, how he managed to start his first fund after pitching his coworkers when he quit his job, and how Praxis has pivoted from single-family flipping focused to multifamily focused. If you like my show notes for this episode, go to multifsuccess.com/EP09, or if you like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back to another episode of Multifamily Success Stories. In this episode, I have the special honor of speaking with Brian Burke. Brian, would you please introduce yourself to the dealmaker community and let them know who you are and what inspired you to get into multifamily investing?
Yeah, I'm Brian Burke. I'm the president and CEO of Praxis Capital. I started investing in real estate 30 years ago when I bought my first single-family house flip and got hooked. So now I've been doing it ever since. Now we've bought about 760 or 770 properties or something like that, about $500 million worth of real estate, 3,000 multifamily units scattered across the country. And I feel like we're just in our infancy.
Wow. Could you ever have imagined from, when you first started that you'd be where you are today?
Oh, are you kidding? No way. I mean, if you would have told my 20-year-old self that someday I could say $500 million in real estate in my own name in the same sentence, I would have said you were crazy.
So I definitely want to go back to that, those beginnings. That's always one of the fun parts about this show. Tell me about how did you first get introduced to this? I saw that you began your career in real estate in 1989. But did you know about real estate before then? What kind of led you to that point?
Well, I didn't know anything. I had this bright idea that if I could make some money by selling books through the mail order, through a mail order thing. And so one of the books that was offered, and it was like, what would happen is you'd send out letters, people would order books, you would send the order to a drop shipper and they would ship the books. Well, they sent me a sample of all the books so I could see what they were. One of the books was a real estate book. It was a terrible real estate book, and it's probably why they were selling it through the mail. But nevertheless, I read it and thought, oh, this is kind of interesting. You can actually buy property with no money down, and that sounds pretty good because I don't have any money. And it says that you don't have to spend a lot of time, and I'm like, well, that's pretty good because I don't have a lot of time. And it said that you could do it without even a lot of knowledge, and I'm like, well, that's pretty good because I don't know anything. So this is perfect for me. Little did I know that it's not quite that simple. I've learned that over the last 30 years in this business, but nevertheless, that was the one little thing that got me, checking out this business. And once you start, you get hooked and never go back.
So that first book, what was that about? Like, was it that about like wholesaling or something? It was like teaching you how to wholesale.
There was I don't know if the wholesaling was even a thing back then, but it was basically teaching you how to buy real estate with creative financing. And so, like getting the sellers to carry back down payments, wrap around mortgages, just all that kind of stuff that, hardly ever really works in the real world. But I was too young and dumb to know any better. And I thought, oh, you just ask the seller to carry back the down payment. I can do that. And, I didn't think that, everybody says no to that. So I went out and found a property and put in an offer and asked the seller to carry back the down payment. And they said yes. And I thought, great, this is just like the book says. And then, after that, I learned that that almost never happens.
So you got started into real estate because you were actually looking to be selling books, like a drop shipper for books almost?
Yeah, that's pretty much it. Yeah, we were just trying to make a few bucks doing this little mail order thing. And, of course, didn't make a dime off of that. But, had I not done that, I probably never would even thought about real estate.
So for you, real estate, was it a thought of real estate, or was it more just like, hey, this is a way for me to be able to make some money? Like, is it just because you were an entrepreneur that kind of led to getting into real estate?
Well, heck, I was 20. I was just barely out of high school, right? It's like, what did I know? So, I was just trying to figure out, like, I didn't have any knowledge. I didn't have any money. I didn't have any connections. I had nothing. So I figure, what could I do? And then I have a book that says you can buy property with no money. And I thought, well, that's great. And then you read another paragraph and it says, like, all the wealthiest people in the world made their money in real estate. And it's like, okay, you put two and two together, like all the wealthy people came from real estate and you can do real estate without any money. This must be for me. And then of course, like I said, then you learn, it really isn't quite that simple. But nevertheless, it got me hooked.
So that first real estate deal happened in 89?
That was 1989.
And so you got this first property, you followed the book to the T, and then what ends up happening after that?
Yeah, then what ends up happening is, I lose money on the deal, and it's like, ouch, I'm never going to be able to do this again and all that. But then, I still kind of stuck to that concept that real estate really was a way that you could build wealth and, build a business. And so I kept looking around and finally found another opportunity, and I managed to acquire another house, fixed it up, flipped it, made a tiny bit of money, and thought, okay, now I kind of see how this works. And then, did it 2 or 3 or 4 more times and started to make more and more money on each one. And then by then it's, I'm past the point of no return. You can't go back now. Now that you've done like 4 or 5 successful deals and made a few dollars, it's like game over. I got to really go full in on this. And then just really built a business where, I was doing probably about a half a dozen houses a year. And then I started getting into construction. I thought, it would be cool to be able to build some houses from the ground up. That sounds like fun. Of course, I don't know how hard that is to do. I just figured that sounds like fun. So I'll try that. So I kind of got to this point where, I was working full time. I was in law enforcement and I was working full time. And I thought, this job is kind of getting in the way of, being able to build the business. So if I really want to build this, I gotta cut the cord. So quit my job and, raised some money from my ex coworkers and just went out and started, really hitting it. And by then I was doing a couple dozen houses a year and, thought I'd really hit my stride.
So you kept your law enforcement job while you were still flipping these houses on the side, and then at a certain point you said, hey, I kind of want to get into development. What was the reason? Because some people, they stay on that trajectory of like, flipping, and they don't really pivot from that. What made you decide to go that route?
Well, I always felt that, anybody that just does the same thing over and over and over again is, just, it's too one track. It's like, you got to be able to do different things. And, there was a time when it was hard to find flips. And I thought, well, geez, if I can't find any flips, what if I just build some? What if I just build, find some land? And there was, I was buying properties at foreclosure sales on the courthouse steps. And there was a community about an hour away from me that was having a bunch of foreclosures on their HOA assessment dues. And these were on unbuilt lots. And I thought, well, geez, I could buy these lots. I was buying lots for like $7,000. So I'd go to the auction and buy this lot for $7,000. And then, I had my brother-in-law was a contractor, and I'm like, can you build the houses on it? And so I hired him to build the houses on it. And, it was just, to me, it was kind of opportunistic because there was these foreclosure sales on these lots. On the other hand, I thought it sounded really cool to be able to say you're a real estate developer. I didn't learn until after you do a lot of those that, being a real estate developer is really kind of a thankless job, because most real estate developers end up bankrupt sooner or later. And I figured, I kind of was really lucky on my timing when I got in and got out at exactly the right time, and without going under. So now that I've kind of been there, done that, and got the t-shirt, I never want to go back to developing. And I found that I really like just fixing up stuff that's already existing.
So you started off, with the single family flips, and then you moved into development. The skill sets that you learned from flipping, did that really translate over well into development, or was that like a completely different skill set, completely different type of business model that you were trying to, relearn?
Well, kind of both, actually. Both those answers are true. It was completely different from the standpoint that, building from the ground up is a whole new thing, with it and going through the permit process and plan check and all that stuff is really complicated, and getting the financing for construction financing, building and estimates and all that stuff. It was kind of like flipping on steroids. It was like everything that you do in flipping, like on a scale of 1 to 10, you do in flipping is like a 2 or a 3. Well, in construction, it's an 8 or a 9. So it was a learning experience, to be sure, but it was also a lot like flipping in the sense that, you're acquiring the property for one price, you're improving it for another cost, and then you're selling it for another number. And the idea is that when it's all said and done, there's a number left over that you get to put in your pocket. And I learned that, a lot about timing. And, so one thing that we did, I bought about a dozen lots and built about a half a dozen houses. But in that time, the market was going up. And this was like in early 2000s, like 2003, 2004. And I just kind of thought, yeah, the market was getting so overheated. And these lots that I was buying for $5,000 to $7,000 to $10,000 were selling for $60,000, $80,000, $90,000 by now. And I still had a half a dozen of them left. And I just did the math just like a flip. And I said, you know what? I could make just as much money selling these lots as I could building houses on them. So I listed all the lots for sale, sold all the lots. And literally right after I sold all the lots, the market totally tanked. And if I had built houses on those lots, I probably would have lost my shirt.
Do you think that you'd be where you are today if you hadn't sold those lots?
I don't know. I always say that I am where I am today as a product of everything that I've been through and all the experiences I've been through. So, had I done that, it would have been a very painful experience. It probably would have cost me dearly financially. I would have learned things in the process, though, that probably would have caused me to grow maybe in other ways. But it is really hard to say because, maybe it would have took me out completely and I wouldn't have been able to get back in. So it's kind of hard to know for sure whether that would have helped me or hurt me. I mean, it certainly would have hurt me financially, but career-wise, I don't really know yet.
You were developing these properties. Was this at a certain point, though, you said like, hey, I'm putting in a lot of effort, I'm putting in a lot of work, and were you not seeing the types of returns that you wanted to see compared to like when you were flipping the properties?
Oh, it was even better. I mean, these were probably more profitable than any flip I'd ever done. They were, and it was really good times. And, so it was kind of a tough decision to say like, hey, maybe I should stop building these houses and just sell off the lots. But there was just something about it that, just a feeling I got. And I thought, you know what, I can make just as much money selling the lots as I could the houses. Why not? You don't have to you don't have to take on the risk. You don't have to put up all the extra money for and get construction loans and all that other stuff to build the remaining houses, but yet I get the same profit. Now, of course, the greedy side would be easy to say, yeah, but by the time I go to sell those houses, they'll be worth even more and I'll make even more. But you know what they say, right? That what is it? Bulls make money, bears make money, and hogs get slaughtered. I figured, hey, I got out, I made good money. I didn't get greedy. Had I gotten greedy, I probably would have gotten bankrupt.
What was that time frame? You said that was around, you were flipping for around 10 years, and then another 10 years was around for development?
Yeah, the development, I started that in around 2002. So I was probably only flipping for, I guess I'd been flipping for about 12 years by that point. And then I built for just about 3 or 4 years, because I got out, I think, in 04 or 05. And our real estate values here in our area started tanking in the middle of 05. And by 06, they were in full on free fall. By 2008, our prices had gone down between 30 and 70%.
what were some of what do you think was the biggest takeaway? I mean, 12 years into flipping, I mean, you have a lot of experience in that realm. What do you think was maybe kind of the biggest thing that you were able to take away from that really transitioned well into your development experience?
I think a lot of it was just managing, construction projects. When you're managing all these renovations and stuff like that, you learn a little bit about construction techniques and, what a little bit of decorating stuff and, what you like about floor plans and don't like about other floor plans, because I custom designed the floor plans we were building, with my architect. We custom did those. And it was a concept that, by and large, I came up with because I knew the kinds of things I didn't like about a lot of floor plans that I saw, and I wanted to change that. I wanted to have a better product than what the other builders were doing and what was done in the past. And had I not had a chance to have been in so many houses, I probably wouldn't have known any better.
Did you feel like you had a little bit of a edge in the development space because of your experience flipping?
Yeah, probably not. As much as I would have liked to think I did, reality was there's a lot of home builders out there that had so much more experience than me. So I certainly couldn't claim that I had any edge over those guys. Maybe I had an edge over somebody that had never done it before. But most of that, construction and building trade is dominated by people that have made a whole career out of building stuff. I don't know why it is, but some people just like to build stuff, and that's what they do their whole life. And I found that I really don't like building things. I actually like taking things that are already there and making them better. I've found that I'm much better at that than I am at building things.
So after, you sold off the lots, you were able to get away unscathed. What was what did you do during that interim as things are kind of going down? Were you thinking, okay, back to my regular job, or do you think like I'm still all in, just on to the next? What was that transition?
Yeah, that was a tough time. There was probably there were, I think 3 years or maybe even 4 years there where I was doing, 2 dozen houses a year. And all of a sudden I was buying like 4 houses a year if I was lucky. I mean, I think there was one year I bought two. And so, this whole time I've always been focused on buying the properties at foreclosure auctions on the courthouse steps. That's how I got all my lots. That's how I bought all my flips. And I thought, so at this point, I'm only buying stuff that I could get at such a discount that even if the price fell by 10% in the 6 months I owned it, I could still make a profit. And boy, it's really hard to find stuff that meets that criteria, but I managed to pull it off. And had just enough to do to keep me busy. At the same time, I was also looking at other areas because I'm like, okay, California's really fallen hard, right? I mean, we took the brunt of the foreclosures in that time period, but there were other states that weren't doing so bad, and I looked around and I saw places like Texas and, the Midwestern states, and Buffalo, New York was another example of another place I went. And it's like, values didn't really fall so much there. And so I started looking in those markets to buy. And by this point, I had a little bit of multifamily experience from some multifamilies I'd started buying around 2002, right around in there somewhere. And decided that really, a good business for me would be to be buying multifamily and buying those out of state, outside of California. And that's really what kind of got me started in looking around for multifamily. There was nothing that made sense to buy here, so I might as well look elsewhere. And the rest is history.
What about the multifamily though? I mean, you had 12 years of doing, the residential flips. Why not go back to that and scale that business model? What was the pivot?
It's exactly what we did, actually. Once the values kind of stabilized at a lower level in like 2008, our values had kind of started to trough out a little bit, and yet the foreclosure volume was enormous. There was hundreds of foreclosures literally every day being sold to the courthouse steps. So I built a huge business buying those houses, and sometimes we'd buy 3 houses a day. And we were doing well over 100 houses a year, buying them, fixing them up, reselling them. We had 25 employees. We were running like 100 miles an hour with our hair on fire. And in order to finance all of that, we had to raise a lot of money from investors. And so in raising all that money, it started to think about like, hey, what's going to happen in 3 or 4 or 5 years when all these foreclosures are gone and we've raised all this money? We need something that we can pivot the business to so we can keep all of these investors, happy, so they don't just take their money out when we're done and go and do something else. So that's when multifamily really started to become a big focus of the company, was more of like an outlet for the capital that we'd raised for our flipping business. Was, we wanted something that was sustainable, scalable, and we could do for the long term and really, really grow it. And that's exactly what we did. We turned to multifamily and started, as we'd sell off houses, if we weren't getting as much volume, we'd have all this extra capital. We'd return that capital to the investors. They would redeploy it back to us in multifamily projects. And that's kind of how we really got the ball rolling in a big way.
So Praxis Capital, you started back in 2001, and that was focused primarily on residential, like single family flips?
Yeah, so actually, I started the company. The first thing that Praxis Capital ever did was build houses. And at the time, it even had a different name. It was named Burke Homes Inc. It's very creative, right? And that was my construction company. And then over the years, when we started getting out of single family and more into being a capital markets business, which is really what we are, I changed the name a number of years ago. And so, our focus really is, we're a financial services business where we provide investment products for investors, and those investment products center around a variety of real estate opportunities. And so, now we are the sponsors of passive real estate syndications in both the single family and multifamily space.
So you went into more of a syndication model at first, but now you've switched to more of like a fund?
That's right. We started out, our first offerings were actually funds. We always did everything in funds, and they were all single family. So we were, like, for example, when we were flipping, we raised a really large fund, and we had complete discretionary control over the capital, so that we could buy any house we want. And that's, we really had to move quickly. We would know in the morning, we'd look at our list of 100 potential houses to buy, and we'd go to the auction at 11 in the morning, and by 11:15 we owned 2 houses. So there's no ability to go out to investors and say, hey, do you want to invest in this house? So we had everything we did was on a fund. And then on the multifamily side, we started out with the syndication model, where because we had more time. We were buying on market through an escrow. We were raising multiple millions of dollars. So on that one, we started going to an individual syndication model. And so we were buying our multifamilies on syndications and our single families on funds. And now fast forward, we're kind of circling right back to our roots, and we're going more to the fund model. We just launched our 10th fund a couple of weeks ago, which is our PM Multifamily Value Fund 6, is our 10th fund, and we're raising money for multifamily acquisitions. And this will be blind pool money, discretionary capital, so that we can go out and just acquire multifamily as we find opportunities through the pandemic.
Definitely want to talk about the fund model, but going back to a few years back when you were doing these flips and you were scaling that business, how were you raising the capital originally? Was this like your own capital, or were you playing around kind of like with a fund? Like what was your model back then?
Well, my very first model was I would take every credit card offer I got in the mail, and I'd apply for the credit card and got approved for all of them. And I took a whole stack of credit cards to the bank, handed them to the teller, and said, cash advance them all to the max. That was my first way of raising capital.
Do you advise that today?
Well, hey, I was young and crazy and had nothing to lose. So I guess maybe if you're in that position, knock yourself out. But, I could never advise somebody that's the way to do it. It just so happens that's the way I did it, because that was the only choice I had. I didn't know anybody that had money, and certainly nobody with money would have been dumb enough to invest it with me, who was young and dumb and had no experience. So instead, I did it the way I did it, and I wouldn't change a thing. I mean, it was how it got me to where I am today. But after that, I started figuring out that it's actually a lot easier if I could just meet some people that had money, that would invest with me. And of course, after having kind of quote unquote self-funded through credit cards and whatever other means, a couple of flips and gotten a bit of a track record and show people what I do, I could get people to invest in me. I mean, my first investor, I think, was like $7,000. And, but that was all I needed to get into that one deal. And so, over time, you just build, that trust and track record with people when you can show them what you've done. But the real growth spark for me was when I quit my job, when I quit my law enforcement job. I put in my 2 weeks notice. I told all the guys, I said, hey guys, I just put in my 2 weeks notice. I rented the room down at the community center. I want all you guys to come. I'm going to tell you all the stuff I've been doing in real estate for all these years. And, so you can hear why I'm quitting. And so they all came, and I gave this whole presentation about real estate and median values and flipping and all this other stuff. And I'm like, if any of you guys want to invest with me, you can give me your money, minimum $5,000, and I will split the profits 50-50 with you. And I literally walked out of that room with $500,000 of investment money from 28 investors, all carrying guns. And that was how I got jumped into the fund business.
Wow. So I hope the SEC is not listening to this, but that's a quite a story. How did you? So you took that capital and you said, okay, were you going to use that capital in its full, or were you saying like, hey, I'm going to use this and then leverage like the bank's money? Like how did you do that initial fund?
Yeah, so the initial fund was the documents were written by my lawyer, and so if the SEC is listening, they were 35 or fewer people, and I had previous personal relationships with every one of them. So we knew that we were within the legal boundaries to do what we were doing, but we had completely discretionary control over the money. So I could buy basically anything I wanted with that capital, as long as it was real estate. And so what I would do is, when you're buying at the courthouse steps, you have to pay in cash on the spot. So in other words, cashier's checks are fine too. So what I did is the $500,000 goes in the bank. I would go to the bank. I would take it out in cashier's checks. I'd go to the auction with $500,000 in cashier's checks in my pocket. I would bid on the house, get the house, sign the cashier's check over to the trustee. I would get a deed to the house. And when I got the deed to the house, I would go to my private money lender and I would borrow the money against the house. So let's say I bought the house for $250, and then I would go to my private money lender and borrow $200. So I started out with $5. I spent $250. I had $250 left. I borrow $2 from the private money lender. So now I have $4. I'm almost back to whole again, and I could repeat. So I got to that point, I could buy about 24 houses a year with that same $500,000. So it worked out really, really perfectly.
So with that initial, when you said like, hey, like I'm ready to quit, but I can't keep using my credit cards, I have to be able to find other people to be able to help scale this. Was your first thought like, hey, I'm going to start a fund? Or like, most people maybe don't even really think of funds. A lot of people, they might just think of like, a syndication. What made you kind of pivot to that route?
Because I knew I needed discretionary control over the cash. If I'm going to go to an auction, I have to be able to go get the money and I have to be able to spend it. And I don't have time to ask for permission because, again, there's auctions every day. There's numerous houses going every day. I don't know which one we're going to get. And the biggest way to fail in the auction business is to only go after one property. And this is what people do. They'll go out and they'll go, oh, I found this house in foreclosure. I'm going to chase after it and I'm going to focus on it. I'm going to buy it. And then, somebody else gets it, or it postpones, or the, borrower files bankruptcy, or whatever the case is, and that house doesn't go to auction, or they didn't get it at the auction, and they have to start over from scratch. And instead, I took the approach of, I'm going to study every single house that's going to every single auction. I'm going to know everything about every property. I'm going to know exactly how much they're worth, what it's going to cost to fix them up, who's living there, all that stuff, so that when the auction goes, I'm prepared to bid on every single one of them. And I will do that until I get one. And that's how we did it.
So during, at that time, like how many people were just doing like what you just said, like they were really banking on that one property, like that single flip, versus you who was coming in and you were just like, hey, I know, my risk tolerance, I know how much I can put into these properties. And you just started going out there. Like how many people were in your domain versus what everybody else was doing?
Yeah, in my county, there was probably maybe 5 or 10 guys that, really did what I did and really focused on it, looked at everything, were prepared to bid on everything. And then I couldn't even begin to estimate how many one and doneers that would come to the auction, only prepared to bid on one house and you never see them again. Or, they would do one at a time and you'd see them like every month they would be there and never got anything. And then you never saw them again. Hundreds and hundreds of people I've seen try to get into this business and not succeed at it.
And what's the reason? Do you think that it's too tough to do those one properties one at a time? Do you think it's only a really scalable model if you are, doing more of a fund structure for these flips?
It's a professional's game, and there's no real room for casual investors when you're buying at auctions. There's too many pros that do this for a living to give much room for the casual investor to get in there and grab something. So, usually when you see somebody that's a casual investor come and buy something, it's either because they were willing to outbid everyone because they wanted to buy it as a personal residence, or it's because there was something wrong with the title and they didn't know about it. So they bid on it, but none of the pros did because they knew they'd just lose their investment if they bid on it. But the amateur didn't understand that and bid on it and then subsequently lost all their money, or had some other kind of real challenge. Or, maybe everybody knows that, oh, you don't want to buy that house because, that guy's going to meet you on the porch with a shotgun, and he'll use it. So let somebody else have that one. That's the only time the casual investors, they just got to clean up the scraps.
So, so you started this fund, and this is really kind of where Praxis Capital started. But then you said you switched to doing a syndication model. What was the reason? If you already were successful in doing these single families, what would make you go back to doing a syndication where it's like that, quote unquote, that single flip?
Yeah, well, it's one thing to raise, two, three, four, $5 million once and use that money for several years. That's one thing. It's another thing to raise $5 million every time you buy something. And let's say if you're buying something once or twice a year, and now you're raising all this money, it's difficult to do that when you don't have a huge following of investors, because to do that in a fund, because when you're raising money in a fund, the investors that are investing don't have any visibility into what it is that you're buying. So, if you're just buying houses, it's kind of like nobody cares, especially if you've done hundreds of them. It's like, look, we've done hundreds of houses. People would invest drop of a hat, no problem, because they've seen our track record. They know how many times we've done it. It's not an issue at all. But again, we keep the money and we just keep recycling it over and over again. On the multifamily side, it's like, well, how many large multifamilies have you done? Well, 4. Well, that's not all that impressive, right? It may be a lot because that could be 1,000 units and some people never even get to 1,000 units, but that's not a lot. So, people want to be able to see the asset. They want to be able to see your underwriting. They want to double check your numbers before they make a commitment to invest. So, when you're first, in your early investments, syndication model is really the only thing that works. There are people I've heard of that, oh, it's my first foray into multifamily. I'm going to go raise a $50 million fund. It's like, good luck, because no one's going to invest in that. Or if they do, it's going to be a much smaller number than you think. And so that's why we didn't even try the fund model. I just waited until we had enough scale, enough deal flow, a strong enough track record, a robust enough team to be able to attract capital into a blind pool fund for multifamily at that scale.
That's pretty interesting because, you already had success with a fund, so you had investors that trusted you. Just because you weren't primarily focused on multifamily, that you said like, hey, we're going to start off syndicating as opposed to pulling money to acquire multiple multifamilies?
Yeah, no one cares. It's like if I could have done 5,000 house flips, but this is a multifamily property. So nobody cares about your 5,000 house flips. They want to know how well you've done in multifamily. And if you say, well, this is my first one, it's like, okay, well, I'm not going to just give you my money without even being able to see the asset. to let you go out and try this for the first time. Go learn on your own dime, or let me see the numbers first and double check you before I write you a check. I mean, that's basically the way it's going to work. So, you've got to build that track record and prove to people. I mean, not only do you have to be able to successfully buy multifamily property, you have to be able to buy it, operate it successfully, sell it, and achieve results before anybody's going to just blindly trust you to say, like, okay, I have no idea what you're going to go buy, but here's a blank check. Just not going to happen.
Going back to that first, that initial fund where it was your coworkers. That you capped out at a certain point. How did you have to approach people, or how did you have to approach investors when you were trying to raise additional capital and stepping outside of your immediate circle?
Well, it's funny because I didn't raise money for years. Once I raised that initial cash, I just kept using that same money over and over and over again. And we actually sustained the business for years just on that initial slug. And then what happened was after the market collapse, there was so much volume out there that, literally was like drinking from a fire hose. And I knew that we really had to scale, and that meant raising a lot of money. And it also meant fixing up a lot of houses. And, I had enough experience to be able to do couple dozen, but to do 100 houses a year and really run, like, that's a production style business. It's almost like an assembly line when you get to that kind of a level. And I knew that if I really wanted to build the business to look like that, I needed somebody's help. And just by a stroke of luck, I met a guy at the foreclosure auction that turned out to be one of the largest home builders in our county, who said, hey, we can't make any money building homes because the homes are worth less than the cost to build them. And so we're trying to figure out how to buy these foreclosures, but we can't figure it out. The process is so difficult and the bidding is so competitive, and we can't get anything at the auction. And I said to him, I've got that down to a science. Why don't we team up? Because I need your help on the construction side. You guys are a production home builder. You guys have built thousands and thousands and thousands of homes. So let's take your production home building business, twist it around to become a production home remodeling business. We'll couple that with my acquisitions platform, and we'll conquer the world. And that's exactly what we did. But we were able to do that because, as a large home builder, he had a lot of connections in the community and stuff like that. So we had a few people we could go to say, look, this is what we're doing. We've teamed up now. Would you give us some funding? And we were successful at doing that. So it started out just with inner circle, right? I mean, my first fund was with my coworkers. The second run at raising money was really with my partner's inner circle of people he knew in the community. We didn't really start raising capital from unknown people until after we then took that production style platform and really had a track record with it. I think we did about maybe close to 100 houses before we went out and raised an additional tranche of capital that came mostly from people we didn't know. And the way we did that was we were able to just leverage the track record and say, look, this is what we've done over the last year. We made like a 35% return for our investors. And, would you invest in it? And even though everybody thought real estate's toxic, the market's falling, yada, 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 we were still able to pull it off.
And so what was your approach to that though? Was it just simply like, here are the numbers, here's what we're able to do, here's our history, and then people said, I'm into it? And how is that different from when you were, when you decided to start getting into the multifamily space? Was it, when you were like raising for the syndication, was that completely different? Like how you would approach people or how you were able to raise that capital?
Yeah. So on the single family side, of course, this was a fund. So what we would do is we would go to people and we'd say, look, we're buying houses at the foreclosure auction. Last year, we bought 100 of them. Here's some pictures of the 100 houses we bought. Here's the purchase price, the resale price, and the profit. And here's the percentage return we made for our investors. And people would see that and they'd go, oh my gosh, this is incredible. How do I invest in this? And it'd be like, great. We opened up a new fund, minimum $100,000 investment. And we built up a second fund just for that purpose. Then for multifamily, when we decided to scale into that business, what we did is we first found a deal and we underwrote all the numbers. and we held a little event. We asked all of our investors to come, and by now we'd had a couple hundred investors, I think. We asked them all to come, and we were going to present this opportunity and give them an update on what we've done. So everybody came, and we gave an update. Hey, we bought another 100 single-family homes. This has been the profits. This has been the return. And by the way, we're also expanding into multifamily. We found this property. Here's what the property is. Here's where it is. Here's how we got it. Here's what the numbers look like. Does anybody want to invest in it? And you see the difference there is, the first was a fund. Now we're saying, here, look at this property. Will you invest in it? So here what we were doing is we were getting people to invest in a single asset syndication. And of course, people were like, hey, you guys did great for us on the houses. This property looks really good. The numbers look really good. I'll invest in it. And then, of course, we use that when we did the second one. Look, we did this before on this property. Now we're going to do it on this property. Will you invest in this? And of course, yes, they would. And they would invest in that one. And then, after you do a few dozen of those, then you can say, hey, we're going to go after multifamily in an even bigger way. Here's a history of all this multifamily that we've done. Here's what they look like. Here's what we bought them for and what we sold them for and what the rate of return was. And then people were like, hey, whatever you want to do, you guys know what you're doing. We'll invest in it, even though we have no property to show them. So that's how the progression is. And there's really no shortcuts. You have to go through all of those steps to really get to that point.
So it sounds like you're doing just a bunch of small wins. It wasn't just because you had that experience, running a fund, being able to get a return, that you could just immediately jump into a completely different, not a completely different sector, but just a different niche, and then people are going to trust you. You still felt like you had to build that credibility before you just went out and said, like, hey, I'm going to start a fund, and a bunch of people are going to give me money just because I have experience elsewhere.
That's right. I mean, even now. So now I've been doing this for 30 years. We've got, 250 million in assets. I've bought $500 million worth of real estate, 3,000 multifamily units, 750 something properties. Our team has 100,000 units of multifamily experience, and we've got this great fund that we've launched. Well, now if next week I come to, your audience and I say, based on all that, we've decided that we're going to raise a $50 million fund to go out and buy industrial warehouses. People are going to look at us like we had two heads. They're going to be, what do you know about industrial warehouses? You've got multifamily experience. You got single family experience. You got residential development experience. All that's fine, but you've never done an industrial warehouse before. What do you know about doing that? Well, nothing, but we're just going to go do it. Well, if I was an investor, I would say, tell you what, show me the deal. And if I like the deal, maybe then I'll invest in it, because I trust you, but I don't trust the deal, and I want to make sure that I can see the numbers. So there you go, right back to single asset syndications again, right? So if I were to do that, or if I were to buy an office building or a hotel or whatever it was, it would have to be back to the syndication model, so I could show the investors what my projections were, what the numbers look like, and why I believed in that deal. I would not be able to do it on a blind pool.
What has been the most challenging part of scaling your business?
Geez, the most challenging part is it just takes a long time. This is a trust-based business. People will invest with you only because they trust you, and it takes a long time to build trust. So, it's a slow progression. I've been doing this for 30 years, and I finally feel like we're just now kind of hitting our stride and, really being able to scale. And, it just takes a long time.
Do you think that, with the syndication model, because a lot of people are interested in getting into syndications, do you think that that's a sustainable model, just focusing on syndications, or do you think that that's one step and then the next progression is to a fund?
Well, they're kind of the same thing. I mean, all a fund is just like putting multiple syndications into one deal. I mean, the main difference is that the trust level the investor has to have with you, because now they don't trust the deal, they have to just trust you. So that's the biggest hurdle to getting into a fund model. But really, it's the same business. You're gathering up capital from a number of investors to invest in a real estate venture. Whether it's identified ahead of time or not is really the main difference between a syndication and a fund. Otherwise, it's essentially the same thing. So, I think it's a sustainable model. but it's not what most people think. A lot of people think that the syndication business is a business where you get into the real estate game with no money of your own, no experience, and just be able to go raise money from other people and buy massive quantities of real estate without any of your own resources. And that's just not what this is. There are a few people maybe that have managed to pull that off, where you have the blind leading the blind, basically somebody doesn't know what they're doing, never done a deal before, and they go out to investors that don't know any better, and they invest in it. And oftentimes, especially depending on markets, it might have even been successful. But there's also just as many stories where those ventures crash and burn because nobody knew what they were doing, and people lose money. And you hear as many stories about people who go to jail because they swindled investors, when really what they did is they were well-intentioned at the outset, but screwed it up completely in execution and ended up finding themselves in prison. So this is a serious business. It's not a game. And it's not something that is a get-rich-quick scheme. This is a financial services business, like a bank or any of those kinds of things. You're accepting someone's hard-earned capital and being entrusted with it to make good decisions with it.
What do you think? What do you think is more challenging to do to try to grow? Was it doing those those syndications, or was it now you have a fund where you're dealing with multiple investors, and now it's just up to you to pick the deals?
Yeah, I think the syndications is probably the more challenging one, and because when you're structuring as just a single asset syndication, generally you don't have your capital all circled up before you go and buy something. You might know who your audience is going to be and who you're going to go to, and if you don't, you're missing the whole boat. You have to know who you're going to go to. But the biggest challenge is when you go to submit an offer on a property and the seller asks you, where are you getting your equity? And your answer is, I don't know yet. Or your answer is, I've got to go raise it from, a bunch of people that I know. Well, the I don't know yet isn't going to fly. I got to go get it from a bunch of people that I know is going to result in a follow-up question of how many deals have you done with them before? How many have they funded for you before? Have you ever raised this much money before? And if the answer is kind of like none and no and all that kind of stuff, you're not getting the deal. Bottom line. It's hard enough for even somebody like me who can go in and say, hey, yeah, we've done, this many deals. We've raised hundreds of millions from our investors. We have thousands of investors, many of whom invest with us on multiple occasions. And we've never had a problem raising this much money. And in fact, we just did this a month ago. We're still at a disadvantage from somebody who says, oh yeah, we have all the money raised already. It's all circled up in our fund, just waiting to deploy. Do you want us to close next week? That's the difference. And so, the syndication model is difficult because it's hard to acquire property when you're up against other buyers who have discretionary capital.
But you think that's kind of the way that you have to start before you can, start a fund. It has to be through the real grind of, doing a syndication, or even before you can even do that syndication, there's a step before that.
Well, it doesn't have to be. You could go straight to the fund model if you're a trust fund child, if you grew up with a silver spoon and you've got a huge family that has billions of dollars, who is like, instead of like, oh, hey, kid, take the keys to the Corvette. Instead, they go, oh, hey, kid, here's $2 million. Go see what you can do with it. If that is your situation, then go straight to the fund model. Take your parents' money and their friends' money and go for it. But if you're anything like me, where you don't have that advantage, you don't just get to go straight out there and go ask people who have never invested with you before, when you have no track record to show them, to entrust you with 6 figures of their life savings on the possibility that you're going to go out and find a piece of real estate and successfully execute a plan on something they can't even see. It's just very unrealistic to think that's going to happen.
What was your first fund like to where your fund is now? I mean, I'm sure that there's a lot of rules and a lot of things that you have to follow when you first when you're starting off, that you still have to do today. But I'm sure that how you have managed, or how you've worked with your investors and how you've scaled this is very different. What did you do from the beginning to where you are now that is very different?
The biggest difference is on my very first fund with my coworkers, knowing that my audience is a bunch of cops, not rich people. My minimum investment size was $5,000. And I had investors that came in at the minimum, $5,000. And it's funny, I still have some of those investors that are still in that fund to this day. But 30, 20 something years later. But now anything that we do now has $100,000 minimum, and that's a big distinction. And the reason is now we have a lot bigger investors. We have a much broader audience. Some of the things that we're doing, like our latest fund, is a 506c fund offering, which is a securities code section that allows us to advertise the offering, but we can only accept accredited investors, which means $1 million net worth or more than $200,000 in income. Well, when I first did my very first fund, I didn't know one single person that had $1 million net worth or made more than $200,000. Now we've got a couple thousand of them that are clients of ours, and that's a tremendous difference from where this all started.
So moving into the 506c, where now you're going to be marketing, what's the reason for that? You were previously using the 506b, correct?
Yeah, we were using 506b before. The reason I did a 506c on our latest offering is earlier this year, I launched a book through my publisher, biggerpockets.com. The book is not a marketing piece, but I didn't want to take any risk that the Securities and Exchange Commission might view a recently launched book as a general solicitation. So just to take the ultra cautious approach and make sure that I'm completely within the boundaries of the law, we launched this fund as a 506c, which means that we can only accept accredited investors in this fund, and we have to verify that all those investors are in fact accredited. So that was the real impetus. We've in the past worked with non-accredited investors if we had a relationship with them, and we would establish that relationship before we would allow them to invest in any of our future offerings. And we probably will do that again and allow non-accredited investors to invest in future offerings down the line once we've had a chance to get to know them. But we just knew that we would probably get an influx of leads coming to us, wanting to invest with us as a result of having either heard about the book or seen the book, and I didn't want to take any chances.
And how long have you had the 506c fund open now?
We literally launched it 2 weeks ago.
Nice. And has it been some good feedback since you launched it?
It's almost fully subscribed.
Wow. And that all came because of the content that you put out, or were you doing other marketing?
We didn't do any marketing. The only thing we did is, we've got a tremendous database of clients that have invested with us for many years, and also new people that come to us all the time. Maybe they heard me on a podcast, or, who knows? I don't know how they find us, but we do essentially no marketing. I always say I'm like the worst marketer ever because we just don't do any of it. Almost all of our people come to us from word of mouth referrals, other investors telling friends, that sort of stuff. So all we did was we just put out an email and said, we're going to do a webinar on this day to talk about our new fund. And we had like 900 people sign up for the webinar. And then after the webinar, they all started filling out subscription agreements. So it's mostly just, we've got that track record, we've got that history, and that's when you're ready for a fund. I mean, that's why I say that, raising a fund is difficult, because you first have to get the trust of the investors, and you have to have the track record to show that you're going to be a good steward of that capital. And that's why we were able to raise that money so quickly.
What is the biggest mistake that you see new real estate investors doing?
Well, paying too much is one that I see. Buying crappy real estate is another one that I see. Investing in really bad markets is another one that I see. I love it when you see somebody bragging about this great new deal they just got, and you look at it and it's like it's a 60s deal in Little Rock, Arkansas or something, and it's like, okay, that's like on the ranking of the best performing cities index by the Milken Institute. It's like, fifth from the bottom or something, just some ridiculously terrible ranking. And it's like, okay, old property, bad submarket, it's like, why are you doing that? So I see that a lot. And I think another one is just people trying to go too big too soon before they're ready, and they can't raise the money for the offering that they're putting together because they don't have the audience for it.
If you had to go back from scratch and redo all of this, what would you do differently?
Not a thing, because even the mistakes I made, and I've made my share, and some of them have took an enormous toll. But everything that I just believe that everything that happens to you for a reason and shapes who you are. And had I taken my worst experiences off the table, I wouldn't have been pushed to have grown the way that I did. And, as I heard somebody once say, that as you climb the ladder to success, what used to be your ceiling now becomes your floor. And, you kind of grow through all of these challenges. And, that's how you make it in life. I mean, no Olympic runner came out of the womb running. First they had to learn how to crawl, and then they had to try to learn how to take their first step, and they probably fell and hit their head, but said, I'm not going to fall again because that hurts. And then eventually they learned to walk, and then eventually they learned to run, right? And this is the same kind of a thing, that if you really want to make it big in this business, you have to learn how to crawl first, and then take your first steps, and then learn how to run.
And what have been some of those biggest failures that you had along the way? I mean, when you're dealing with, investors in a fund, and, a lot of expectations and a lot of, rules that you have to follow, is there room to really mess up, or do you really just have to have all your ducks in a row the whole time?
There's really not much room to mess up when you're dealing with other people's money. And so, for me, I learned most of my lessons, in the early part of my career. And what I would always do is, whenever I'm doing a new strategy, like something I haven't done before, I would always do it with my own money first. And even if it was my own borrowed money, an equity line on my house, my credit cards, whatever it was, I would try it myself. And I lost a lot of my own money in these experiments, learning what not to do. I've done self-storage, I've done hotels, I've done construction, house flipping, vacant land, residential subdivisions, all these different things. And I've fortunately, knock on wood, I've never lost a dime of investors' money. And I've sure lost a lot of my own. And, in part because I was either experimenting, or if it was a fund where I had investors in it and the deal lost, I paid up and, gave the investors their money back and didn't let them suffer the loss. Didn't have to, but, I felt it was better, because how else can I still say 30 years later, I've never lost any investors' money? And that's important to me. So it's a learning process, and those mistakes are powerful and painful. But if you make them with your investors' money, it's a death sentence.
Do you feel that even right now that there still is a learning process for you during this time, or do you feel like you don't have to get a bunch of gray hairs and stay up super late at night, like things are kind of moving along steady as they should?
Well, I got my pilot's license when I was in high school, and I've been flying airplanes ever since. And they always say that a pilot's license is a license to learn. And every time you go up in that airplane, you learn something new. I don't care how long you've been doing it. And it's the same thing with real estate. Every deal, you learn something new. Every transaction, you learn something new. Every day, you learn something new. Even after 30 years of doing this, I learn new stuff constantly. And that's the value of experience. And that's why investors invest with us, because they know that, most of my rookie mistake phase is over with now. And the mistakes I learn now are recoverable, because, you learn most of the things of what not to do, but you're still going to learn new stuff all the time.
What's a question that you have for maybe someone that's at a similar place than you, or someone that is at that next step that you're looking to go to? What are some of the things that you're questioning right now, or that you could ask them?
Gosh, if I could run into somebody that's really made it big, I would be asking them, how did you get the capital backing to get you from the individual and high net worth investor stage into the institutional world? because that's the next step for us, and that's the one we're struggling with the most now, is growing into that more institutional space where we can get somebody to write us a $50 million check to buy a $125 million deal. And it's not easy to do. It's difficult to crack that code. And that's the code we've been working on cracking for the last few years. And it's kind of the next stage to our growth, right? It took us 30 years to get to 3,000 units. Hopefully within the next 20 years, I can get to, 300,000 units. I guess we'll see how it goes.
And what do you think is so different between what you're doing now versus the institutional?
It's really just, with high net worth investors, you get a lot more control over what you're doing. And when you're investing with institutional, they get a lot more control over you. And so, it's easy to show, a high net worth investor, here's our plan, here's our track record. But an institutional investor, it's, they got billions of dollars that they're responsible for. But, in a lot of cases, you're dealing with, somebody that's actually never even worked out there in the real world, in the field. They got a college degree and went to work for this institution that has billions of dollars to place. And, they're smart people, no question about it. But, it's just a much different dynamic to navigate.
And what's the best way that someone can reach out to you, Brian? If anybody has any questions, if they wanted to know more, I know that you mentioned your book on Bigger Pockets. What's the best way that they can reach you?
Oh, geez, lots of stuff. So, of course, Bigger Pockets is a great place. Biggerpockets.com. I'm on there answering questions on the forums all the time. Got some blog articles you should check out. The book is The Hands-Off Investor. It's available on biggerpockets.com/syndication book. Recommend that for sure, but I'm biased, so of course I'd recommend it. You can find us on our website, praxcap.com. It's praxcap.com. If you're interested in our fund, it's investwithpraxis.com. And of course, I'm on Instagram at Investor Brian Burke or at PraxCap.
Awesome. Well, thank you so much, Brian, for sharing your story. It was really quite, an awesome journey to see where you're going, where you've gotten, and also to where you're going. Would love to be able to get you back on the show once you have cracked that code and you have now you're working with the institution. I think that'd be, really excited to see where you're going to go.
Can't wait for that episode. Thanks for having me on.
All right. Take care, Brian. Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.